back to another episode of Policy and Profits. I'm EJ Antoni. I like to, play an economist on TV every now and again, but more importantly, I am joined by the one, the only trader extraordinaire, the Wall Street maverick himself, Anthony Esposito, head of Ascalon 6 Capital. Anthony, how are you doing today? How's your week been?
EJ, week has been good. Trader extraordinaire, very appropriate this week. There's been a lot of activity on the desk. We have no shortage of signals, no shortage of headlines, no shortage of volatility. So we've been busy. It's been good. We're actually having a very strong month, I'm happy to say. At the fund, we were definitely positioned well. We've been short equities, long crude. And we're long gold originally over that initial weekend of the initial bombing campaign, beginning of March, and actually came out of gold with the run up in dollar. We saw dollar strength becoming an issue, and gold didn't act as well as we expected coming out of that weekend. So we actually came out of gold, and for the most part, we've been out of crude now after our long trade. And we're focusing really on equities and volatility. So trading the VIX, trading S&P 500 futures and Russell 2000 futures. So that's kind of in our total universe. Busy but good, I guess, would be the short way to say it. We definitely have a lot of headlines and information coming out of the Middle East and the war, out of the White House, out of Israel, out of the EU, if anyone's listening anymore. But there's been some economic data that's come out too. And you pointed out two really interesting things, as usual, on X recently. We had the PPI numbers, the producer price index came out yesterday. And then you went into a Brent crude, WTI crude conversation, which we've been on the desk and trying to figure that spread out. So I want to go into that as well. But PPI numbers come out yesterday. And I had to laugh because as we were in the office, we have the final demand month over month come in at 0.7 versus 0.3, prior 0.5. And then we have the X food and energy year over year come in at 3.5 versus 3.4. X food and energy year over year comes in at 3.9 over 3.7. So I laughed because we had, and final demand, year over year, 3.4 versus 3.0. So everything hot. We were trading. Everybody was in. I have two traders on the desk with me. And as the number hits, in unison, everyone goes, "Oh!" as we're trading, and the number hits because futures were already starting to shake, and we were positioned short equities and kind of trying to figure out if it was going to be one of those head fakes or not. And that number hit, and it was like the beginning of really a mudslide yesterday, which was a pretty ugly day. But you were out on X to get away from the antics on the desk for a second. You were out on X. And you went through these numbers, the numbers that I just laid out, and it's been an undertone topic, right? The war is obviously taking massive headlines, but talk a little bit about these PPI numbers. We've been saying CPI, the true inflation numbers on an annualized basis in particular, have been coming down. Things look like they were settling. Now we see these PPI reports come in pretty hot. What does this mean now, and what does this mean as far as direction? Have we shifted gears, and are we headed back to a higher inflation regime?
Great question, Anthony. Unfortunately, it does look like we are heading back to some higher, some more inflationary pressure. There's just no other way to say it. And again, there's a bunch of different reasons for this. Some of it has to do with the runaway government spending that we continue to see, and the Federal Reserve financing that's problematic. Growing the money supply. The Fed is back to quantitative easing, which we've talked about in previous episodes, right? And there's also the issue of now energy, right? That's become the really big wild card. One of the big drivers in this last PPI wasn't the only thing, but one of the big drivers is diesel. And that's really the lifeblood of the economy. We talk a lot about gasoline because the consumer feels that most acutely when they fill up. But diesel, believe it or not, affects a lot more prices than gasoline does. Every time you go to a store, you grab something off the shelf, it got there on a truck, right? And even when you're just trying to get it cross country, let's say from one port to another, or from a manufacturing facility to the final destination, it's going on a train, also diesel, right? So again, diesel is really the lifeblood of the economy. I think we're going to continue, unfortunately, to see those prices tick up in terms of these official reports. Even if the market prices we're seeing right now are the peak and they start trending back down, they're going to show up in official reports in the months to come. So that's I think something that we're going to see. Now, to your question on all these different types of crude, we had Tim Stewart on last week, right? He was doing a great job explaining to us a lot of these cross border flows. And one of the things that that we see is the fact that so much of this depends on refining capacity. And it's not just overall refining capacity, but what kind of oil are your refineries really set up for? In other words, where's the optimization? One refinery might be optimized for handling heavy crude. Another one is set up to handle light crude. Well, a lot of the refineries that we have on the Gulf, for instance, handle that heavier crude. This is why Venezuela was such a great steal for the U.S., right? It's the fact that now we were going to be getting the exact kind of crude that those refineries are set up to handle versus a lot of the West Texas Intermediate or even the Brent. Brent is another light sweet crude. A lot of those are refined elsewhere around the world. Now, that doesn't quite then explain all of the difference between that kind of blowout that we saw on the spread between Brent and WTI. I think that more so had to do with all of the speculation around an export ban. In other words, saying no more WTI can actually leave the country. Well, if that's the case, you've just removed a huge source for demand for West Texas Intermediate. And as soon as the announcement came that no, we're not actually considering that in the Trump administration, all of a sudden WTI started to catch up to Brent, and that premium on Brent really shrunk.
Yeah.
And so again, I think a lot of it just has to do with speculation at this point, right? No, nobody has any idea what's going on. And I'm not saying this as like a criticism. It's just this is the fog of war, right? We saw Israel strike a bunch of natural gas infrastructure in Iran overnight, and then Iran retaliated and hit natural gas infrastructure throughout the region. That wasn't priced in before. So what happened? Well, natural gas futures, of course, spiked. We literally just have no idea day to day, even hour by hour, how exactly the conflict is going to unfold. I mean, we can speak about it in very broad terms, I think, right? The US is way bigger, whether it's by population, by economy, or by military. So it's not really a contest from that standpoint. I think it's just a question of how much damage can Iran do to energy infrastructure and energy just targets broadly, including ships, before they finally give up. And I think that really explains a lot of the volatility we're seeing and why it's just so impossible right now for anybody to definitively say be short or be long in something like oil.
Yeah. Yeah, it's interesting. And the spread here, just to follow up, I'm looking at WTI versus Brent. We have Brent at 108, WTI at 95. That spread is a negative 12 and change, negative 13. The mean spread is negative 1.5. So we're way off still. There's definitely some catch up to happen. This is just the capital market side, the trading side of that conversation. I also would add, anecdotally, I think it's really funny, and this is somewhat a political observation. In 2022, we had crude spike to 100, and we had gasoline $5 at the pump on a national average. And the Democrats' response was, "I stand with Ukraine," and everybody got a cool little pin and waved
That's right.
our nation's flag. In 2026, we have crude at 100 and prices at the pump at 384. And everyone's response is, this is not worth defending our homeland or our United States citizens. So it's the Dems' response, and the difference in the response to that price action is actually, I think, all telling and is very interesting. So we're definitely looking at a market that's been obviously volatile. And I don't want to say that, we had some big rallies coming out of the initial announcement on the March 2nd, as we came in on March 2nd. The market actually held around, and I'm talking about front month S&Ps now, held around 6950, above 6900 for a couple of days, which was interesting. Again, we had been short. We've been leaning short since December. The reports I've put out and everything I've talked about has been a December in 25 that was very similar to a December in 24. The setup was the same. This is actually a little more egregious, and I think we have more downside than I thought even coming into 26. But then we had the tariff tantrum, which kind of pushed us lower. But we were topping out anyway. Those ticks around 69, 69.50 coming through the first few days of the war were the market trying to digest the shock of the war, and a lot of people suggesting that war is bullish. Some of those data points you can make an argument for. Some of them were kind of skewed, but overall, this seemed a little different. Now, as we've started to digest these issues, is this a structural change in energy? Is it a structural change in other items like some foods, like fertilizers, like helium that is needed to cool semiconductor chips in the process of being made? Now we can't make chips, right, in South Korea or in Singapore. We don't have, in Taiwan, we don't have the actual helium coming from Qatar to be a part of that process. Like, all these little things are the market digesting and everyone digesting. Is this a structural change or is this a blip? Right now, I don't think the market knows, but it's cooled off quite a bit. We're down about, on the lows today, peak to trough, we were down about 7%, 6.8% from the top, which really is a blip. I think for a lot of people trading, they're very young. They were not around for the tech bubble. They weren't around certainly for the late 80s, but they weren't around for the 2000s. They weren't around for 07, 08. And they're smart and they're legit and they're running a lot of money, but they just don't have the life experience that we've had, because coming out of really a 102 and definitely 08, 09, there's been a put in place where it has been by the dips. Like we've had shocks, but we haven't had true bear markets, in my opinion.
Are they kind of perma bears? Do you feel like these younger folks?
No, I think they're the opposite. They're by the
excuse me, perma bulls.
They're perma bulls. They don't understand. Like, I had somebody actually, a good friend of mine works at an energy materials hedge fund up in New York, and he had sent a document over about kind of the answer to a question from clients from a sell side analyst. And the question from the clients was, did we see capitulation? And I was like, well, and I laughed when he sent it, which he knew I would. I said, we're down 5%. So capitulation happens down 30, 20%, 30%, 40%, 60%, 08, 09. Like, it doesn't happen down 5%. 5% is tea and crumpets and you move on with your day. Like, that's not a big deal. But people feel like this is a big deal because they haven't experienced it and they don't know what to do with it. So, I had asked my traders who are young on the desk the other day, don't look at the screen for a second. How far down do you think we are in the past 3 weeks? And the answer is 10, 15, 12%, even though they know it's not. Their feel is, just because of how it feels, is it's a lot worse than it is mathematically. And I think that's really important, because the buy the dip people, in my opinion, will become a kind of coming to Jesus moment where it's not working. I don't know why it's not working. I haven't seen this before. I need to get out. And that will be the first. We're just in the recognition phase, in my view, of the bear that's coming. And the war has been kind of a curveball put into a pot of stew that was already cooking. It's not the event. The headlines are interchangeable. It's an event which is getting things going. But the bear market that we have coming, that I've been looking for and anticipating, is just getting started. So we're in what you would call the recognition phase of the bear. And then the next phase would be the fear phase. So recognizing, hey, there might be a problem. The fear of, hey, I don't want to lose money. And then the capitulation phase at the end, where you're like, I've lost enough. I don't care what I have to sell. I don't care what the price is. This has to stop. I need to stop the bleeding. And that happens at the end of a bear. It certainly doesn't happen, down 2.5% or 4% from all-time highs. So that all said, I think that the market is coming to terms with what is the structural effect of this war. And then we're going to loop back into private credit, which has become an issue recently. We're going to loop back into AI and valuations, CapEx spending, employment, all the fun things that we get to talk about. But this is definitely becoming a part of the mix. We've been sticking to a chart. I don't want to say it's a simple chart. I don't want to say it's a basic chart, but I like to, KISS. I keep things simple. When they don't need a lot of bells and whistles, they don't need a lot of bells and whistles. This is the monthly chart. I believe this is our fourth time looking at this. So we've looked at this for 4 weeks now. This is a rising wedge on the upper right of the chart. That's where we are now. When we started this, we were within that wedge. and we were stuck right between the 50-week and the 10-week moving averages, so the red and the blue lines. And we looked back to December 24 into the beginning of 26, and we had two circles highlighting resistance that was hit at that time. I'm going to pull mine up. So that was the 6,400 level. As momentum on a weekly basis shifted negative, that was all not bullish. We saw that big dip down during the down to the April lows of 25. And then we saw this big rally out. Now, what I've noticed and what I've recognized is we started to see weekly momentum shift back to a negative as we've entered kind of a rounding top on the daily and a rising wedge formation on the weekly. This is a bearish formation. We've now broken the base of the formation. You can see I have TP target price 1 at 6,600, target price 2 at 6,400. The 6,600 target has been hit 2 times now, 2 separate days, today being one. 6,611 was the low on these front month futures, so I'm going to count that as a hit. We bounced off of that, so we're now 6660 on the close 3 minutes ago in the futures market. So a little bit of a bounce off, a lot of news to go through, but we've double tapped 6,600. We've hit that target. That 6,400 target is actually a measured move down from this formation, and that would give us about a 10% sell-off peak to trough, which would be a typical correction, not a bear market, just a typical correction. They happen. No one should be shocked by that. I still believe we're in position to hit 6,400. The catalyst for that, for me, does not matter. The news headlines, the craziness does matter. But what matters above all is the charts, the formations, and the Ascalon 6 capital model that we follow internally, which is a momentum trend model specific to our fund and to our desk. All things seen, we're seeing this topping pattern continue to develop. I have no doubt that we may get some bounce to the upside on incrementally good news from the Middle East, maybe a cooling of the bombings, a de-escalation of sorts. I think that probably escalates or re-escalates. Even if it doesn't, I think that we have some issues on the underneath, as I mentioned, valuations, leverage, private credit. The fact that the financials are dragging this year and are massively the underperforming group is not bullish for me at all. There's a bunch of things I can go through, but the bottom line is you could put me in a dark room with my Bloomberg screen and my trading front end, and if I could look at the charts and run the ACAP, the Ascalon 6 capital model, I'm okay. I can see the headlines in the numbers. I can see the headlines in the charts. I don't really care what they are as far as trading goes. We hit 6,600. This structure is still in place. It is bearish, and I would expect 6,400 to be coming in the coming weeks to months, but probably by the end of the second quarter, as we make the turn into the end of the first quarter, I would say that 6,400 is pretty much a lock from point A to point B. I would not minimize the volatility we'll see within that, and that's part of the challenge at ACAP, where we're trying to manage our point A to point B thesis, but not get eaten up in the volatility and the price volatility within. But if we're talking point A to point B, 6,400 is a magnet here, and I think we'll see it in the coming 2 to 3 months.
And to your point, Anthony, I know you've said a lot, but you're absolutely right how the headlines are interchangeable. And what you're looking at are the numbers and the formations and what the what the Ascalon 6 model is actually saying, right? Not the headlines. It amazes me how to this day a lot of folks can't agree on what caused the initial sell-off in October of 1929 in the stock market, right? And it really genuinely was as if it was something that was just baked in, and anything could trigger it, and maybe it was different things for different people, but at the end of the day, it was going to happen, right? Just based on essentially what you were saying, based on the metrics.
That is exactly it. There's always a headline to point to, and that's fine. I mean, there has to be a spark, right? But the fact that you're standing in a room of fireworks is really the issue. It's not where the spark came from. It's the fact that you're standing on a pile of dynamite, playing with matches. So I think that's the point, and that's kind of how I live, and that's how we perform. And thankfully, as I said, we're having a very good month this month. Obviously, prayers and thoughts are with the military and the action in the Middle East and Iran. I don't want to see anything that's going on, but it
Right,
is going
right.
on. And what we're seeing in the charts is coming through. It doesn't matter. The headlines just don't matter to me. The sparks just don't matter to me. They're for the CNBC and the Bloomberg News to pontificate and chat about and take their left right opinions on. But for me, it's just about making money for the clients and for the fund in a vol adjusted way that makes sense. And that doesn't include headlines. Honestly, it just includes price.
Yeah, exactly. And you're absolutely right. Look, we pray for all the servicemen and women, and pray for their speedy return, right? And that that we get the conflict wrapped up, and that consumers can get back to buying cheap gasoline, because that's going to go a long way for a lot of folks right now. You mentioned that the consumer debt problem,
Yep.
that's only going to be made so much worse
Yep.
with gasoline going up this much, with a lot of folks who are sadly already living paycheck to paycheck now having to put higher gasoline bills on a credit card that's close to being tapped out, close to being maxed out already. So
Yeah.
a lot to look out for in the weeks and months ahead.
Absolutely. And remember, Biden had gasoline at $5 a gallon. Trump
Yeah,
had it at 284, 282. So
bingo.
we're fighting a massive. This is a real conflict in the Middle East, more disruptive than anything I remember. And
Yeah,
we have and due to Trump's policies, we have prices at the pump on a national average at 380. So we still haven't even. That just shows you how poor policy was under Biden. That it was
right,
a
right.
Russia-Ukraine war. Middle East wasn't even touched. The Strait of Hormuz was not even an issue, and we had gasoline at $5. So, and the only way he brought it down was to release the Strategic Petroleum Reserve, which Tim spoke about last week, in an artificial way to lower prices at the pump as we're depleting our strategic reserve in case of war, which, by the way, he didn't replace, and which, by the way, the Democrats pushed back and fought Trump when he wanted to replace. So I think it's going to be an issue. It is an issue. Everybody feels it. I feel it. My kids feel it. I had my daughter come home the other day, and I can't believe how little, I put $60 in the car, and it was only a little over half a tank, and normally it's a full tank, and I get it. Look, it's
Yep.
difficult. The bed has been made, and the mess. We keep saying clean up in aisle 7 from the Biden administration. It's a real,
Yeah.
but this too shall pass. And I think the very, and I'll end with this. I think the very clear, concise, and objective, and adult in the room comment from Trump and from Vice President Vance has been, if you're not willing to forego some price at the pump and some disruption of life to prevent the number one funder of and sponsor of terrorist activity in the globe from having a nuclear weapon that could reach anywhere in the world, then I think you need to rethink where you're at. I know things get tough and things are hard, and trust me, I've been there more than most, but at the end of the day, this didn't need to be done. This is not an Iraq, Afghanistan war. This needed to be done. If we need to get over the speed bump to clear the hurdle of a nuclear armed Iran, which, by the way, was being funded by Obama and funded by Joe Biden with taxpayer dollars, just putting it out there. You need to think about the bigger picture at times, and we make our adjustments, we get through life, and then we'll move on. But that said, the U.S. economy, the consumer is strained, and I think we're going to start to see some structural changes here in the coming quarters, which the market is pricing in, but not fully pricing in yet.
Anthony, thank you for another awesome episode. Great to be with you, my man. We are going to have we're going to be glued to our screens day by day as we watch things like the S&P and oil behave like a meme stock
That's it.
until this is done. So, thank you again for an awesome episode, and great to be with you.
Thank you, EJ. I appreciate it. At Real EJ Antoni. Again, your posts are phenomenal. I'm there every day. And you are very active. At CMT_Anthony. If anyone cares to look at any of the posts on my from Ascalon 6, some charting, some calls, and some posts that I think are relevant to the market and to the economy. You could also go out to Ascalon6capital.com or reach me at Anthony.Esposito at Ascalon6capital.com. EJ, you're the man. I appreciate it. I know you're traveling, so be safe, and I'll talk to you soon.
Till then.